U.S. industrial production fell sharply in July thanks to a larger than expected impact from Hurricane Beryl. The drop comes after the sector had increased production in both May and June. In today's Yahoo Finance Playbook, we're looking at how to navigate the industrial sector. Joining us now to discuss is Brian Sponheimer, Gabelli Funds portfolio manager. The other piece of recent news that we got as well, Brian, was better than expected numbers from Deere, so at least the farm part of the industrials economy. But let's go for big picture first right now and tell us, where are we in the sort of industrial cycle as it relates to the economic cycle?
First of all, thank you for having me on. I think, when you think about industrials, it's really not a one-size-fits-all market. If you look at the XLI, anything that's been related to energy, anything that's been related to aerospace and defense, anything that's kind of had this AI halo attached to it has done very well. And then in some other markets, like in the machinery space, it's been challenging. And I think, you spoke to the Deere numbers, and we can talk about that in a minute, but it's really been a question of less bad than feared with some results. Caterpillar, certainly during their second quarter earnings call, talked about a lot of different end markets from an outcome perspective, where construction was coming off, energy and transportation was doing okay, mining was showing some difficulty. And so a lot of the commodity-driven spending, as we've seen commodity prices on a global basis come off over the last 6 months, is really impacting a lot of these names.
Brian, you mentioned Deere, and so let's dig into that one, because they did recently report results better than expected. Your thoughts on that name, Brian?
Yeah, so we've seen within the agricultural space, corn now below $4, soybeans are now below $10 a bushel. And I think when you look at the valuation multiples of a lot of these companies, whether it's Deere, whether it's CNH, really trading on trough valuations with an expectation that it's going to be a really difficult market for ag machinery companies for the next year to 2 years. Deere's numbers themselves were very good, mostly from a margin perspective. The company has done an excellent job over the course of the last few years on what's known as precision ag. So that's ways to make the job of the farmer easier from an output perspective, certainly as it relates to labor productivity, areas such as autonomous tractors and combines, areas such as see and spray technologies, et cetera. So Deere, while results were good from a profitability perspective, they're seeing the top line pressure that's really being felt across the space. And I think that was a welcome relief rally for the shares following their earnings.
Is Deere stock you like right now? I mean, the other, to be fair, the other ag equipment companies are also doing precision ag to varying degrees, but Deere still seems to have outperformed. Would you own it over some of the other industrial ag companies?
Deere's been a great company. I think it's relatively attractive at these levels. I think it becomes a little more attractive if we were to get a sell-off. We like CNH, its biggest competitor, and a bit of a fast follower in the precision ag space. Clearly, Deere is the vanguard of the industry. They have been ahead of everyone from a spending perspective and from a technological perspective. With CNH, which trades at around 10 times earnings, if we see another cut out of the company, is about 70% of the valuation of Deere, and a company that has some financial engineering characteristics that we could see develop over the course of the next year and a half. So on a relative basis, I like CNH. I'm happy to own Deere here as well, and our funds do own Deere.
What about AGCO, Brian?
Yeah, AGCO, a bit of a stock that's more in transition. They're selling the GSI business that they bought about a decade ago. A company that's trying to really kind of find itself, and also is trying to find its way within the precision ag space. So on a relative basis, not as much my favorite. I prefer the other two.
And then, Brian, just quickly, one question to you on the rental equipment space, right? Because you got some really big players like United Rentals as well. Is that one that investors should be looking at right now?
Yeah, we love the rental space. It's about an $85 billion industry in North America that's, while dominated in some respects by United Rentals, it's a relatively fragmented industry. So you've got United Rentals having just over 15% of the market. Ashtead, which runs Sunbelt, is about 7 to 8. Then you've got Herc Rentals, HRI, which is about 4%. And this industry is one that is leaps and bounds more efficient than it was a decade ago. Telematics, better spending, better inventory management, and larger players being smarter about how they utilize their equipment. They're all helping the construction industry find better ways to be more efficient and also show test cases where renting equipment is much better than owning it. And so we've seen not only a good amount of growth within the space, it's been profitable and it's helped drive cash flows. United Rentals is a great company based in Stamford, Connecticut, that has said that they can now be cash flow positive at any point in a typical cycle. HRI is growing their business, doing a terrific job in doing so. So those are two names that we like. URI, I could certainly envision continuing to do everything that they've done over the course of the last 15 years and becoming the company that they have, and HRI truly becoming a fast follower in that space as well.
Brian, thanks so much for your time and your stock picks. We appreciate it.
Thank you very much.